So Jim, another question that I have is regarding the actual accounting statements for colleges and universities. Can you talk a little bit about how accounting statements developed, and then what the various accounting statements that we have in higher education, and what do they do? How do they inform the reader about the status, the financial status of a college or university?
Yeah, I think if you look at the basic financial statements that we find in colleges and universities, they really consist of three basic statements. One is the statement of financial position, and that simply gives you a summary of the assets, which are those things that the institution owns, its liabilities, which would be those things that the institution owes to others, and then an equity portion, which would be the differential between your assets and liabilities. So essentially that would be your equity. The statement of financial position, sometimes
called on the statement of financial position. Can you just give us a couple of examples of what an asset is and what a liability is in terms of some of the specific line items?
Yeah,
that we would see.
Absolutely.
In those categories.
The assets, as I mentioned, are those things that the institution owns. So that way, if we look at the assets, they are typically arranged based upon their life or the liquidity. So cash would be probably, in most cases, the first asset that gets recorded on the statement of financial position. Accounts receivable, which would be money that would be owed to the institution. So a student's tuition receivable would be the money that the student was billed but not yet has paid. Similarly, you'll have investments if they have a portfolio where they've received funds over time and they are now investing them to generate income. Fixed assets, which would be those long-lived assets that they're using in operations. So those are the kinds of assets that you will typically see on the statement of financial position, which is also sometimes referred to as the balance sheet. When we flip over to the liability side, essentially what I was referring to earlier was that those are the things that you owe to others. So, for example, money that you owe vendors because you've acquired certain goods or services but have not yet paid that bill are accounts payable. You may also have liabilities that you owe to your employees. For example, you might have a vacation a vacation policy that says that you owe a particular employee a certain number of days vacation time or sick time, whatever it might be, and so you would have a calculation of the money that you would owe that particular employee. Similarly, if you have a pension obligation that you owe your employees,
you're going to get the money in the future.
They will be getting that money in the future. If you have borrowed money to buy or construct a building, the debt that you have on your books, similar to what you might have as a mortgage as an individual person, that would be a liability as well. And so in order to make the accounting equation balance, you've got your assets minus your liabilities, which would be your equity portion. And in the financial statements of a college or university, that equity portion is referred to as net assets. And there are three different components of net assets: unrestricted, temporarily restricted, and permanently restricted, which I think we're going to pick up in another question. Then similarly, we've got a second statement, which is the statement of activity. And if you take that into a corporate environment, that would be your profit and loss statement. It will summarize all of the revenues that the college or university has generated, and that would typically be tuition and fees, student housing, contributions. If they're receiving any grants or contracts, those revenues would be reflected as revenues in the statement of activities. Similarly, the funds that you're paying for your operations, like the salaries and the benefits of your employees, if you're buying supplies, your general operations and maintenance of your facilities, your IT, your library costs, all of those other costs get accumulated as expenses. And then when you compare your revenues to your expenses, you'll have either a surplus or a deficit at the end of the year, which would be reflected in your statement of activity. And the last statement is a statement of cash flows, which basically looks at all of the sources and uses of cash that were accumulated in a particular year. And there are three different components of that cash flow statement that we would be looking at. Cash that's used for operations, cash for investing, and financing.
Jim, if I could just ask you a quick question, particularly when you talked about the statement of financial position, the first category or the first statement you talked about, what does someone look for in that? In other words, to kind of assess, it's a sort of intuitive on the second category where we look at revenue and expense. If your revenue was $100 million and your expenses were $110 million, that probably isn't very good. In other words, you've had a deficit of $10 million, or conversely, if you have revenue of $100 million and you have expenses of $90 million, you had a surplus. But the concept of the statement of financial position is a little trickier in the sense of what might be some of the proportions and what do people look for to measure the health of an organization by looking at the balance sheet or the statement of financial position.
Yeah, that's a great question, because if you compare and contrast those two statements, the statement of activity will summarize a year's worth of activity. So it shows you a year's worth of revenues, a year's worth of expenses, and then comes down to that budget surplus, that operating surplus or deficit. When you compare that to the statement of financial position or the balance sheet, the thing to keep in mind is that you're looking at what your assets and liabilities at a particular point in time, and generally speaking, it's going to be at the end of the year or June 30th in the examples that we've been using here. And so one of the key things that I always looked at when I was an audit partner was we wanted to look at the financial health of the institution from a liquidity perspective. I certainly want to make sure that when I look at the net assets section of the balance sheet, that an institution had available unrestricted and temporarily restricted net assets in order to support their operations on a go-forward basis. If I saw a deficit in a net asset category, I was always very concerned, because that was an indicator that we had some budgetary deficits or operating deficits that have accumulated over a long period of time. From a cash perspective, I always wanted to make sure that there was liquid assets on the balance sheet. I wanted to see a healthy cash position. I wanted to make sure that accounts receivable, or those tuition accounts that were due from students, are actually being collected, and that they're valid and collectible receivables. From an investment perspective, you're always concerned about how much investment is set aside and what are the types of returns that an organization is looking for. The other thing that is always very critical are, do we have a lot of debt on the books of the organization? And I think the whole notion of an institution being over-leveraged becomes very critical. I think one of the trends we're seeing now in higher education is a number of institutions are struggling because of drops in enrollment to make their debt payments. And so that, I think, is unfortunately going to be a phenomenon that a number of institutions are going to grapple with. And so you want to make sure that you don't have a situation where an organization is got so much debt service that they can't pay that on a regular basis.
So I guess at the risk of oversimplification, if one made the analogy to a household, and then you were trying to figure out as a household or a personal individual what shape I'm in, if I really shouldn't be borrowing too much money, and I should have some money in savings and reserves in case I get laid off or something unexperienced happens, or I have a health setback, or so forth and so on. So we need to have cash. We need to have reserves. We can't spend every nickel. I mean, sometimes we may have to, unfortunately, but we would prefer not. We want to have some savings, and we don't want to take on too much debt.
Absolutely.
So if I lose my job or something happens, I don't have such a big burden that I won't be able to pay it where I have unforeseen circumstances.
Yeah, and I think the example of the household situation is right on point. I think, unfortunately, some of that discipline doesn't carry over with some institutions and vice versa.
Thanks a lot, Jim.